Welcome to the vault, where the noise stops and the real money conversation begins. This is not hype. This is not headlines. This is macro metals markets, powered by the first ever AI-generated market recap. If you're here for the long game, you're in the right place. Let's get into it. A violent 14% overnight silver crash was driven by forced algorithmic liquidation and systemic plumbing stress, not fundamentals, creating a huge east-west price gap that one might argue is bullish for physical silver. Silver plunged from about $83 to $73.72 in minutes during thin holiday liquidity, triggering media claims of retail panic and a bursting bubble. Mechanical liquidation and negative gamma caused the crash, not a change in silver's value. Around 2 a.m. Eastern Time, a highly leveraged institutional whale breached maintenance margin and was auto-liquidated by a risk engine that dumped thousands of contracts into an almost empty order book, while dealers gamma flipped negative, forcing them to sell more as price fell and creating a self-reinforcing liquidity cascade. $34 billion Fed-backed liquidity injection stopped a potential clearinghouse failure, proving systemic fragility. As the whale's losses blew a hole in CME's balance sheet and repo spreads spiked, the Federal Reserve funneled $34 billion into overnight funding just to keep banks lending and market makers quoting, effectively placing a concrete floor near $73 and revealing how over-leveraged and bailout-dependent the paper silver market is. Physical markets and retail behavior contradict the bearish narrative, pointing to a fake paper-only crash. Shanghai silver closed near the equivalent of $89 per ounce, about an 18% premium to Western prices. While export controls block arbitrage, COMEX vaults saw a 600,000-plus ounce withdrawal just before the crash, and ETF plus bullion dealer data show retail investors were net buyers, implying the real demand for metal is strong, and that inventory is migrating from weak leveraged hands to strong physical holders.